Hi there, and welcome to the Indiana Farm Equipment and Technology Expo. I'm Eric Pfeiffer from Hoosier Ag today, and we're proud to put on the show. And, if you've been watching us on Facebook or on our YouTube channel, it's like we've been live like constantly the past 3 days. It's because our seminar stage it's been absolutely packed. We've had great speakers throughout the show. We still have a little bit more to come later. I know I've got Dan Quinn and Sean Castile with Purdue Extension coming up in just a little while. Come to the show, pepper them with questions. Would love to hear what you all have to ask them. So come on down for that as well. We're here on the Bain Welker Equipment, Ag Direct, and Farm Credit Mid-America stage at the Indiana Farm Equipment and Technology Expo. We're at Grand Park in Westfield, so if you're watching, don't go to the fairgrounds. No one will be there. Come here instead. We really appreciate everyone coming out today. And our next presenter, he's been doing this for a few days now at the show, so he should be really good at it by now. I think we're gonna be good to go. Jason Powers is a business owner and wealth strategist with an eclectic and exciting background in real estate investing, sporting event photography. So if you get a moment, ask him about that. And he founded an international nonprofit, and he does wealth planning. It says in his bio that he specializes in working with farmers. And I don't know about you, but I've worked with some farmers, and they're not always easy to deal with. So if he specializes in that, that's pretty good. Jason Powers.
All right, thank you very much. Yeah, I'm excited to be here this morning. Like you said, this is our third day, and I got my biggest fan up here in front. This is our third day, and it's been fun. I am passionate about this stuff, and I could get long-winded about it, so they may actually cut me off. We'll see how it goes. I this eclectic background. I started out 22 years ago in the photography industry. Um, my parents had their own insurance agency when I was growing up. My dad did auto, home, business, health, life, and so I learned a lot just kind of hanging out with him a little bit and just in running a business, right? A little bit. He was just, I learned how to cut shrubs is really what I learned how to do. He'd make me do the landscaping, but when I was a senior in high school, he got cancer. When I was a freshman in college, it kind of was rough on him. By the time I was a sophomore, he passed away when I was in college, and I moved back home, got a full-time job, was helping my mom and little sister out, and but he actually left some life insurance money to my mom. She lived on that, and it helped pay for us for college and things like that. So I sort of had this entrepreneurial spirit early on, just starting my own business, my own photography business. That led to an opportunity to go to India one year. And having never stepped foot out of the country, when someone asked me, hey, you want to join us? There were 5 others going. They said, hey, you want to go to India with us? We're going to go there. We're going to run around, take pictures. I'm like, sure, why not? Totally ill-equipped for going overseas to a third world country. And so we went, culture shock. But we went to so many places. We went up to northeast India, between Bangladesh and Burma, just below Tibet, into the jungles, visiting some of these villages. According to one of the villages we visited, we were the first foreigners to visit them since the late 1800s, just to give you context of how remote we were in the jungle. They were headhunters until the 40s. Fortunate for us, they had quit before we got there. So it was neat, but that really laid on my heart, that trip. We came back, and me and a friend started an international nonprofit kind of out of that, working with tribal villages in northeast India, economic development, water, self-help groups, things like this. So we did this for several years, just a grassroots organization. And let's see what happened. 2008 to 2010, the economy tanked. You guys remember? The economy tanked, so did we. We didn't survive that with the funds. But what that led to is I started watching people, and you might remember, right? You might remember people were losing their jobs, people were running out of money, people were getting foreclosed on left and right. And I started looking in the real estate business going, man, there's got to be a way for people not to have to like foreclose on their homes. Like how do they just all of a sudden, these families are on the street? We saw a lot of it. I was in Denver, and we saw a lot of that. Being in a kind of a documentary side of photography, ended up partnering with the city and county of Denver's homeless initiative for a while. And we did a big thing on Denver's hidden homeless, kind of debunking the stereotype of what homelessness is. And and as you get out there, you start finding out, right? Just like you said, these families 2 weeks ago were not homeless. They were living in a nice house. They lost their job. One thing led to another, and all of a sudden they're homeless. There's a lot of stuff like that. So we did that for a couple of years. And that led to, I was introduced to, I was this starving artist, right, at the time. And it led to, I heard someone speaking on a podcast, and he was talking about how you can recapture your debt and get ahead at the same time. He was talking about how you can finance your own real estate deals. I was getting into real estate at the time. He was talking about how you can be your own bank. And I thought, well, that sounds interesting. So I perked up, I listened, I called them, I talked to them, and I learned about it. And I loved it. And I started practicing it in my own life. So that was about, what, 2012, 2013. Fast forward, and now I get to teach people. I loved it so much, I got into it as a career after I was practicing it, and I love it. And I specialize with, working with the farming industry, with business owners, with real estate investors, because you guys understand cash flow. You understand the need for capital. You understand the need to get money to make money, right? And so that's what I want to do, is kind of just teach you today about how can you work towards being your own bank over time, not a brick and mortar bank, right? But set up your own private family banking systems. How can you do that? So let's dive in today. So Unbridled Wealth, we work with individuals, families, businesses, nonprofits, creating customized strategies for you through education, strategy planning. I probably spend 70-85% of my time educating and then strategizing with you in your situation. It is not a one-size-fits-all approach. It is very customized to you. I call this the private family banking systems. I'm going to explain why. You may have heard of the infinite banking concept as well. We want to teach you how to, we say finance your own deals in the real estate world, create wealth without Wall Street. It's another common one you've heard of. It is not velocity banking, if some of you have heard of things like that. Let's talk about money for a minute. Let me ask you, what keeps you up at night? Well, there was a poll done not too long ago. Not surprisingly, money, right? It keeps most people up. And interestingly, it showed 77% of Americans were anxious about their financial situation. Well, right, in the height of the COVID world, that's not too surprising with just all the uncertainties going on. Retirement was the chief money related worry. That's 68%. Trailing right behind was cost of living and debt, right? Not too surprising. So when it comes to your money, a few questions, if you haven't thought about it, what would you like to do with it? How much would you like to have? When do you want it? And more importantly, why? Why are we doing what we're doing? Why do we work in the jobs we're working in? Why do we work in the careers we're in? Why are we working so hard to make the money? If we don't have a why, maybe we should stop and just think for a minute. Why are we doing it? Nelson Nash, he says, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years' time, 97% of it would be back under control of 3% of the people. Well, why is that? That's because they understand money and how to get it to flow to and towards them instead of away from them. And we're just not taught well, right? How to control our finances. Usually our finances control us, right? And we're stuck trying to keep up all the time. How do we keep up? So pop quiz, show of hands. I'm not going to call you out. Would you rather pay taxes now? Raise your hand. If you'd rather pay taxes now, raise your hand if you'd rather pay taxes later. Okay. Next question. I'll circle back to that. If you had $30,000, would you make more money loaning it to somebody at an amortized loan at 6% for 5 years, or would you make more money putting it in a CD at 4% for 5 years? We'll come back to that. Would you accept an average rate of return of 25% on your qualified investment? How many think taxes are going down in your lifetime? How many think taxes are going up in your lifetime? Right? I'll tie this all together. There's this clear financial problem we have in our country. It's not a secret, right? Interestingly, if you didn't know, 45% of the world makes less than $250 a day, while 80% of the world less than $10 a day. 57% of Americans have less than 1,000 in savings, and 39% have nothing in savings. We look at credit card debt, national credit card debt. It's up to about $1 trillion collectively. Student loans, 1.7. Credit card debt, interestingly, went down a little bit during COVID. It's kind of hit a floor. Now it's starting to go back up. Student loans, 1.7 trillion. Both of those are more than the DOD and Social Security budget combined, just to give you context of how much money that is. What do we got? Home prices, 59% since 2000. Student loan debt has gone up 115%. Family medical, 141%. While the average household income, when you adjust for inflation, only went up 5.2%. That's excluding recently, too. If you've never gone here, go to usdebtclock.org. It shows a live running tally of numbers in American debt. It is both fascinating and depressing all at the same time. It is fascinating, the whopping amount of dollars that are out there. Just in this country, there's this financial problem, right? Einstein says we can't solve problems by using the same kind of thinking we used when we created them. So we got to do something different, right? It's not just about surviving, right? How do we thrive? I'm not talking about getting rich. I'm talking about how do we thrive in our businesses, in our own lives, and not have this financial worry all the time. So 3 types of people, okay? The debtor, the saver, and the wealth creator. The debtor, think about a car. We're going to finance a car. We're going to finance equipment. We're going to pay it off. Let's see, you finance it, go into debt. You're going to pay it off over time, get back to zero. You're going to finance something else. You pay it off over time, you get back to zero. You get that zero line. And you do this over and over and over throughout your life. The saver does the opposite. He says, I'm not going to go into debt over this. So he saves up until he has enough, and he buys it, goes back to zero, saves up again, buys it, goes back to zero. Does this throughout his life. Both instances, right? You get back to zero each time, and then you build the debt or build the savings again. Well, what we want to teach you is how to become what I call the wealth creator, right? It's where you can create this financial velocity that can literally last for generations. And I will talk about the generational part. So this one vehicle can accomplish a lot of different things, okay? How you can begin paying yourself instead of a bank. Pay the interest back to yourself instead of a bank, right? Income tax-free growth, liquidity, use, control of your money, not penalized for early access, not penalized to take too much, not forced to take some at some point, right? Long-term care benefits, legacy. There's this thing called uninterrupted compounding, which I want to talk about here in a minute too, and how your money will grow uninterrupted. So again, we call this private family banking systems or the infinite banking concept. How do we do it? I like this quote by Yogi Berra. He says, you've got to be very careful if you don't know where you're going because you might not get there. And it's so true, right? If we have all these ideas, we want to do something, but if we don't know how to get there, right? So the vehicle, I'm going to break this down for you for a minute, and then we're going to give you some real life examples. So the vehicle that we teach people how to do this is through properly structured dividend-paying whole life insurance from a mutual carrier, which is a mouthful. But I'm worried about it because it is particular. This is not just go down the street, walk into your agency and get a whole life policy. Absolutely not. You get something structured totally different. So that's why I say properly structured, okay? We structured a very specific way to maximize the cash value access in a policy as early as possible and getting that growing as fast as possible, okay? I'm not talking about investment products. A whole life from a mutual carrier. So there's term insurance, which most of you have heard of, and then there's whole life, or some call it permanent insurance, right? It's insurance that's going to last your whole life. Dividend paying from a mutual carrier. There's 2 types of insurance carriers. There's stock owned. The interests are for the stockholders. And then there's mutual carriers, where, say, as a policy owner, you're one of the owners of the company, thus entitled to the profits, which come in the form of dividends. So that's why I said dividend paying from a mutual carrier. The growth rates and the dividends in your policy tend to be way better for this purpose, right? So stick with me. Whole life, it's been around since the 1700s, okay? This is nothing new. We're not inventing something new. It started out as the corporation Corporation for Relief of Poor and Distressed Widows and Children of Presbyterian Ministers. That's actually a short version of the name. So it started basically because these ministers were spending their life in ministry, retiring because they had been supported by the church their whole life, but they'd retire and then they're left destitute all of a sudden, or their families are, because they had been supported by the church. So that's how it started. Fun fact. So who uses this? Banks carry billions of dollars in cash value whole life insurance. Billions. They're insuring their key employees, executives, and as the policy owner, they then can access the cash value during that person's life. Certain dignitaries knew about this, use it. There's an interesting article on President Biden talked about how he owns 0 investment products and 6 whole life policies. You read something like that and you start scratching your head. You're going, what do these guys know that I don't know? You know? Fortune 500 companies, they're using it. They're insuring their people themselves. Fun story, Walt Disney, he couldn't get enough of a loan to build a theme park based around a mouse in California, right? So he accessed the cash value from his whole life policy to finish funding and got it built. Ray Kroc with the McDonald brothers, when he bought out the McDonald brothers, he pulled the cash value from 2 different policies to pay some of his key employees early on, and then start a marketing campaign on his newest mascot. Yes, Ronald McDonald. So it's just fun as you dig around and see who's been using this throughout their life. You could probably think of a couple movies. It's Christmas time where they talk about whole life, accessing the cash value. Okay. Let's talk about where our money, where we're taught to put our money. I'm not going to camp here, just to make a point. If you had $10,000 you wanted to borrow, you'd ask 2 questions before you borrowed it, right? You'd say, how much interest do I have to pay and when do I have to pay it back, right? Well, if they said, well, we don't know, we don't need the money right now, but there'll come a time when we do. And once we do, we'll tell you how much you have to pay. Would you cash that check? Probably not, because you don't know what you're going to have to pay, right? But that's exactly what we do with our qualified accounts. Think about it. If you think taxes are going up in your lifetime, why would you want to pay taxes later? We don't know what direction they're going. We don't know how much taxes are going to be. So, but still, right? Your retirement accounts are based on your opinions, right? What you want to do with your money. Well, if you think they're going up, taxes, there's no direction for it to go right now. But why do you want to put something in where you're going to pay taxes later? Why do you, let me rephrase that. It's not all bad to put money in there. Why do you want to put all of your effort getting all the money in there, right? Or in investment products in general? Would you accept a 25% average rate of return on your qualified accounts? A lot of us out of the gate would say yes, or it depends. But here's what happens. There's a difference between average and actual returns that we don't look into. We don't think about, right? We're not taught this stuff. This is an example of average. If you had $1,000, you made 100% first year, lost 50%. Second year, made 100%. The third year, lost 50. The fourth, the average is 25%. Well, if you started with 1,000, right? You start with 1,000, end with 1,000, but you got a 25% average rate of return on your money. Do the math, you know? So that's why I say always do the math. You're going to be saying that today. What do we got? $30,000. Which would make more? How many of you thought for sure 6% would make more? I did. At a glance. The 4% CD would make more. Well, why is that? It's because the 6% is on an amortized loan. Every year you're paying on less of a balance. You're paying 6% on less of a balance every year. On a CD, it's compounding, right? The growth is compounding. So that 4% year over year is going on top of the new total. So remember I mentioned this uninterrupted compound growth going on. And that's what's going to happen with your private family banking systems, right? Your money's going to grow uninterrupted. I'm not here to sell CDs. I'm just showing you an example of what uninterrupted growth does. So again, lots and lots and lots of advantages. And what we want you to think about as you look at 2 of these examples is How can you begin taking over the banking function in your life? It's absolutely not a process to get rich quick. It's a process, right? And you got to put the effort in initially, right? But it can be done, and it can last for generations. It can. Okay, let's dive in. Enough of the fluff. Real world examples. This is a true example of a client in California. He has a they have some big farms out there, and so they wanted to start something to be able to fund a retirement for a key employee, but also be able to access money along the way and have that growth. So how do they do it? Right? Objective throughout this first generation, right? The objective was, be his own bank. They have $1 million line of credit that they pump through every year. Borrow it, pay it back, borrow it, pay it back, right? We do that with our farms. Or we do that with equipment. Maybe we're buying equipment, we finance it, and we pay it back, right? So he wanted to start replacing that $1 million line of credit over time, be able to fund a retirement and then a generational legacy. So this is what we call an illustration. It's what it looks like when we run them for you, lots and lots and lots of numbers. Don't get caught up in that. I'm going to show you graph form. So if you see on your screen, we're going to focus on the bottom numbers, okay? I don't know how well you can see it. There's the yellow line and then the purple line. All right, the yellow line is his cumulative outlay they were putting into a policy. The purple line right below it is how much they could access back right away. Okay, so they're not out the yellow line. They can access a percentage of it. Okay, let me back up. Couple just choked on the $150,000 number on the screen. Fundamentally, it works the same no matter how many zeros are on it. You want to take a couple zeros off, do that, and it's okay. You want to add a zero, do that. We can get the growth rate pretty similar when you're looking at it, okay? So let me give you this example. They're going to put 150,000 in. They have set aside in their case. He can access 128 of it, right? They were going to be using it. It's like their savings account, right? They'll borrow from their savings account and then they'll refill it. So instead, they pushed it through a policy. Then they could access 128 of it, they'll borrow against it right away. Second year, we reduced that, and they're only paying 75 into the policy for several years after that. So you see the yellow is cumulative. 150 the first year, 225 the second year, 300 the third year, cumulative. Second year, 225 in, 204 out, 300 in, 284 out by the third year. A lot of people start going, now, wait a minute, that's not a good return on my money. Just thinking like an investment product. And I say, wait a minute, what's happening from year one to year two? He put $75,000 in, but the cash value grew 76 and change. Already by the second year, the cash value starts growing more in their case. On average, the way we structure them, somewhere between years 2 and 4, that happens. Fast forward, year 2 to 3, he put 75 in, it grew 80,000. So just in that 1 year, an additional $4,000 growth in cash value access. And now fast forward for this person, they started at age 37. By age 41, the cumulative cash value will exceed the cumulative outlay in their case, because now they've got some momentum going. So on average, the way we structure these, somewhere between, well, in his case, it's about 5 years, but somewhere between year 5 and 10, somewhere in there. Depends on how much we're putting in, how hard we front load it to get that growth going. So somewhere between years 5 and 10, the cash value will exceed the cumulative outlay, and it will never go down. It will always go up from there. Remember, it's not a market product. It's not a market-based anything. So no matter what the market does, the cash value is going to continue to compound year over year over year. Okay. Fast forward, we got to age 66. They will have put in 1.1 throughout the whole life of the policy, but they'll have 2.8 in cash value built up. You with me? So that excess, with that $1.6 million excess, not taxable, because they will always access it as a loan. These are not profit gains. This is inside the policy. You're constantly churning that money to buy more insurance as far as the insurance carrier is concerned, and we will always access that money as loans. and you don't get taxed on loans, right? Fast forward to retirement age, they're 66, they can start. 75, they've got 1.3 in total through the whole life of the policy. They actually stop funding it and they don't pay any more premiums. You'll see from age 75 to 85, 1.3 is the cumulative, but the cash value, because we've got this huge snowball going, has gone from 4.3 to 6.7. That's $2.4 million. They paid nothing into the policy. It grew $2.4 million. What can a farm do with an extra $2.4 million? You've well since replaced that $1 million line of credit, right? So he knows he'll get there. He's going to start replacing it year one. He has $128,000 accessible to start replacing that line of credit. And it's going to build year over year over year, right? He wasn't going to do it overnight. Okay. So they will be able to, on the retirement side, they're actually going to be able to pay. This person has to stay in 15 years. Was the arrangement they set up? If they stay 15 years, they'll be guaranteed the retirement supplement. There's a ratio, but they could fund, if this person stayed to 66, they could pay them $100,000 a year in retirement. The farm owns the policy, has access to the cash value, and is the beneficiary. Okay. So let's say age 66, just an extreme example. Let's say the farm, let's say they borrowed all $2.8 million out, and that person passed away that same year. Well, now they got this $2.8 million loan out. Well, look up straight above that 2.8 on age 66. Death benefits $6 million. So they're going to reduce the amount that's owed from the death benefit and pay the difference. So think about it. Even if they paid $100,000 a year to this person at retirement, did it over the next 20 years, $2 million over 20 years. So let's take it to 85. They've got $8.7 million death benefit coming to them. So they will have paid out $2 million. So they still get about $6 million paid back to the farm later. So they'll more than recapture their money. It's a long play, right? But during the lifetime of the policy, they become their own bank. They take over that banking function in their life. Go buy one of these sprayers and pay cash for it out of your policy for $500,000, and then set up a repayment plan with yourself instead of a bank, and you pay yourself back, right? So, little educational timeout. You've heard me say borrow against. So, no, I'm not saying borrow from. Let me clarify what's going on behind the scenes. Borrow from or against. So we're at the top. Your cash value, you call the insurance carrier, their emeritus here, bottom right. And private family bank is say your cash value. So you call the carrier, hey, how much cash value do I have? They're going to look at your policy, tell you have this much. Say, great, I'd like to borrow X amount. And so what they're going to do is they're going to loan you their pile of money. That's why your pile of money can sit and grow uninterrupted. So behind the scenes, that's what's happening. Now, because they're going to loan you their pile of money, they're going to charge you, depends, somewhere between 3.5%, 5% right now. Okay. We won't get into the weeds of it, but don't get hung up on that 5%. Your most products we have right now, the guaranteed net gross growth rate is 4%. So even if you borrow at 5, it's growing at 4, it's costing you 1. You with me? So 1% is really cheap. Anyway, max cost. Now, remember that graph. Remember the years they paid nothing and it grew $2.4 million? Well, a 5% loan, who cares? Your cash value is growing way more than that, right? It's also an unstructured loan. When you borrow against your policy, they're not asking what you're going to do with it. They're going to send you a bill once a year for the interest that is accrued that year. You pay it or don't pay it. We always say, hey, at least pay the interest. If you're not going to pay the principal back, at least pay the interest. And we always say, always set up a plan to pay yourself back at some point, somehow. We're not going to make you. You don't have to. Like your retirement, when you start taking the money out to retire, you're not paying it back. right? But throughout the life of the policy, use it for things you would normally finance. You're going to borrow it from a bank anyway. Use it for things that will make you money. Borrow the money from yourself. Use that money to make money, all the while the cash value is also growing. So you have this positive arbitrage situation, right? Where it's growing in your cash value, even though the money's out. It's growing uninterrupted, remember? So you borrow that, you get that $1 million line of credit, you borrow it out that year, whatever that cash value growth was projected to be that year, as long as you pay those premiums, still going to grow, even though that million's out. There's no other vehicle that'll do that. Not your savings account, not your retirement accounts, nothing. Okay. Unstructured loan, that's the biggest one, right? How would we like to have a loan where we're going to set up a payment plan back to ourselves, unstructured, and something happens, right? Sometimes, as we know with COVID, right, things get unpredictable. And all of a sudden, you can't pay that bill that you were supposed to pay that month for that loan you have. Well, generally, the bank goes, that's not my problem. We need that payment, that mortgage payment, that financed payment, that equipment payment, that line of credit payment, whatever it is, right? Yeah, with an unstructured loan, doesn't matter. If you're like, well, I can't pay this month or I can't pay this year, you're telling yourself that, right? Or your banking system that. And you can skip that payment and make it up later. Just you got to be disciplined about it. Pay yourself back at some point, or you can't ever use that money again, right? If you just spend it and never pay it back, that money's gone, right? You just won't ever be able to spend it again. Let's ratchet it down a little bit. Smaller example. This is a gentleman who he had saved up. He has a day job, wife, newborn, saved up 25,000, was going to start his own little small farm. And he wanted to, of course, try to be his own bank over time, right? Start the small farm, as well as fund retirement, generational legacy. He's got a newborn, and so it's important to him, right? How can I set my life up? He didn't have any retirement going on. How can I set myself up so that my child will be ahead, and provide for my child, or we're talking life insurance, even if nothing else, have that death benefit coverage to support the family if something happens to me. So again, the illustration, this is what it looks like. Lots of numbers. He's going to do 25,000. We went and changed the flow of the money. Instead of taking that 25 and just pushing it out into the world to start a farm, he took it and we're going to push it through a policy first, the first year. Okay. So again, this is the graph form of it. Similar growth rate. You'll see that first box, bottom right, 25,000 in, he has 18 accessible right away. Second year, he paid another 25. He has 43 accessible. Third year's 25. He has 68 accessible. Same story. Oh, that's not a good return on my money. Now, wait a minute. Between years 2 and 3, it's already grown more than 25, right? It grew 20, just tipped 25 by that year. You see that? By age 37, that middle box, he's got a cumulative 175 paid into the policy, 177 built up. He's been accessing it along the way, in and out, in and out, in and out, right? By retirement, by 65, he's got just over $500,000 paid into the policy through the whole life. He's been using it throughout his whole life. He will have built up $1.4 million in cash value by that point. By age 70, by 65, we stopped funding the policy. We will stop. He won't pay anything else in premiums. His cash value, look at the growth from 65 to 70, went from 1.4 to 1.7. From 70 to 75, went from 1.7 to 2.1. That's $428,000 in growth for not paying anything that year, those years. What can a farm do with an extra $500,000, right? I'm going to break this down. So again, back to the illustration, same numbers here. We just talked about first arrow is year 1, second one down is year 7, and then on down to age 50. Is that third set? He's got 467 in and 675 available. What happens now? Let's apply it. First box, top left corner, 25,000 into the policy. He's going to borrow 18 of it out and kickstart his farm. Okay. He projected he'd make about 45 that year. He has a day job already. He already knows he's going to keep working that day job that year and make as much as he can make. His wife doesn't work. She's going to help on the farm, right? Project he's going to make about 45. He's going to take those profits, pay the original 18,000 back plus the second year's premiums. So now the profits from the business are paying the future premiums is the plan. Second year, he pays the premium. Now he's got 43,000 available, remember? He's going to double down on the work. He's going to borrow 25 out that year. Maybe he makes 80 grand that year. And then he can pay back that 25 loan. He can pay the third year's premiums, extra 30,000, and now he's off to the races. We say rinse and repeat. You could do this over and over and over and over again. So 7 years in, 8 years in, he's got $200,000 in cash value built up. Over the next 10 years, he has a net, after you factor in cost of insurance, a net growth of 148,000 in his case. What can his farm, his small farm, do with an extra $148,000? Again, don't just pocket it, It's not what it's for. I always tell people, don't buy a pack of bubble gum with it. It'll be the most expensive pack of bubble gum you ever bought. If you just buy it and never pay it back, right? Use this money to make you money, or use this money to replace the banking function in your life. How much interest would you save, outside interest, if you're constantly borrowing from yourself and paying yourself back? You're recapturing that interest. You're recapturing that original loan, right? And it's compounding while it's in and out, in and out, in and out. It's still growing all the time. Okay. Let's take him down to age 50. He's got 467 in, 675 available. 10 more years. He's got 529 in. He's got 1.1 built up, and he can do a lot with 1.1 million. We're going to take him down to 65 retirement. 1.4 million built up. He wants to retire maybe at 65. Who knows? Maybe he doesn't, right? You guys never retire. But he can at least start supplementing his income, and the next generation can start taking over the farm. Because now he's got a banking system in place, which the next generation can then begin borrowing from. 60 to 65 grew $300,000 in cash value. He only paid $37,000 in premiums. That's good growth, right? So we either use velocity or we lose it, right? If we're not using it, we're losing it. Let me show this. By age 70, got a bunch of numbers up here, so we'll go through the arrows. Arrows in top right corner. He's got 590,000 paid into the policy through the whole life of the policy. He's got 1.7 in cash value built up. Far left arrow, you'll notice age 71, we stop funding the policy, so he's no longer paying premiums. If you didn't notice, we had been reducing premiums along the way. He went from 25 to 18 and change down to 61.55 for another 20 years or so. So you're paying, we just structured it that way so he could pay less. So we stopped funding the policy. Now back to the middle arrow and start supplementing retirement or funding full retirement at $100,000 a year. This is a one-way ticket for that money. So he's going to borrow against the policy $100,000 a year. Far right column, without the arrows, you'll see the death benefit that would pay each year, factoring in those loans as if never paid back. He could do this for the next 20 years or more. So by age 90, he will have pulled out $2 million in retirement. He will have paid $590,000 throughout the whole life of the policy. Very bottom right corner. Even after that $2 million, the death benefit will still be the $1.4 million to the beneficiary. Can't beat it. Let me take this one step further. I've talked about generational legacy. What do we got next? $1.4 million, right? This, I call it private family banking systems. is to be used throughout your whole life, and you teach that next generation. And what can you do? Here's what you can do. You structure it right. You can set up, say, a family trust, which would be the family bank, so to speak. That money, the 1.4 left over in his case, can kickstart that family bank. Well, really, the cash value he had while he was alive could kickstart the family bank. The kids, the second generation, will be insured by the trust, and the beneficiary of that trust, of that life insurance, will also be the trust. Sorry. So the kids now have access to this family bank throughout their life. And then how much further ahead are they? Because now they're not borrowing from an outside bank. They're borrowing from the family bank, so to speak. And then their legacy, the beneficiary of that money, goes into the trust. When they pass away, they will have insured their children. So now we're at the grandchildren, third generation. And they have an even larger family bank that they can borrow against, right? And they do the same thing. You can do this generation over generation over generation. We hear stories about families like the Rockefellers. They're 6 generations in from doing something like this. It's not beyond our reach. It is because it takes the first generation to start it. It's also because we don't know. We don't know what we don't know. How do we start something like this? This example, this guy started with $25,000 he already had in savings. It was just sitting there. And instead of just taking that money and spending it straight out into the world, pushed it through a policy to start. And if he sticks to it, he teaches these next generations, how much further ahead will they be? Right? I mentioned early on, my father, he left about 1.2 million to my mom. She was to live on it, which she did. Help pay for things like our college and things like that, which it did. Well-intended advice was invest it, live off the interest. And what are we at? This was 1998, and today the money's gone. It didn't even last a generation, right? Why? Because things like 9/11 happened, $400,000 of it disappeared. 2008 happened, $200,000 of it disappeared. So investment growth declined. It got interrupted, that growth. And every time money got withdrawn, that growth got interrupted. I sat and showed my mom this stuff several years ago, and she just sat with her jaw open. Like, she worked with him in the business, and she's like, we never knew about this. We sold insurance for 20 years. They didn't teach us this stuff, how much you can do with the whole life policy, changing the structure of it and doing it different, right? But again, we don't know what we don't know, and uh, just to show, like, I'm risk adverse in lieu of watching my mom, watching other family members, just that money just disappearing, right? Just going through their fingers, but it takes that first generation, and that's why I'm committed. I'm committed to starting it and teaching the next generation and keeping that going, So I like this quote. It's what you leave behind. It's not what's engraved in stone monuments, but what is woven into the lives of others. What's the process? It's a customized approach. It's not a one-size-fits-all approach. We sit down, we talk, go through your goals and objectives. What's your financial situation? What do you want to accomplish? Look at the whole picture. And it's our job, I take the whole picture and move the puzzle pieces around, leave no stone unturned, and see what we can do with it. And we find the pieces. We've got guys. I had a guy, $109,000 in bad debt. Wanted to start his own, banking system, but he's $109,000 in bad debt. Not even finance. Not like a mortgage. And we found a way. He had a savings account. It was an emergency fund, right? What do we do with our emergency fund? If we have $20,000 in savings for emergencies, emergency happens, $6,000 come out. Thank God we had it. What's the very next thing we do after that is resolved? We start paying ourselves back, right? We start refilling that emergency fund back to 20. So what did we do? We borrowed from ourselves, and then we paid ourselves back. So why not have that inside of a policy that's doing something much more than just what your savings account is doing? Have some money in savings. That's not what I'm saying. But what if a vehicle like this could accomplish that? So that's what we did. He took his $20,000, kickstarted his policy the first year, and we had him. He was on a 30-year timeline to be debt free. We got him down to 9 years debt free, had no debt inside or outside of the policy, and had $100,000 to show for it. And there's no other vehicle which you could do that. Last slide, I'm gonna go here to how to get a hold of me. Shoot me an email, shoot me a text. Number's on the screen, 303-250-1755. I would love to chat with you guys and see what's your situation. You're not committed, no strings attached. Let's talk. Let's see what your situation is. Am I too old? That's the most common question I get. Am I too old and how much to get started? Those are the two most. No, you're not too old necessarily, because you can insure family members who have insurable interest. Or you see these guys, the first guy, he insured someone who was one of the managers running his farm. So if they have insurable interest, right? If you're beyond insurable age or anything like that. So it is, don't write yourself off without talking through it. That's it, guys. I love doing this stuff. I have run over my time. Thank you very much. Look forward to chatting with you and see what we can do for you. All right.